operations runs the business and then accounting needs to support operations, not accounting's running and operations supports accounting. Because without operations, you don't have a business and you don't have accounting to worry about.
Welcome to the Better Batch podcast, where batch process manufacturers learn from industry experts. My name is Peter Suttard.
And I'm Alex Kovis. And today we're joined by Shalena Hardy, who has a wealth of experience in manufacturing. And we're excited to talk to you today how to bridge the gap from accounting and operations in manufacturing.
Thanks for having me, guys.
And Shalena, when do manufacturers bring you in?
Most of the time when the manufacturers bring me in, they've noticed something on their balance sheet or their P&L that just isn't quite making sense to them. And so they need some extra help. A lot of business owners don't get into business for the finance side of things and don't come in with a whole lot of finance knowledge. And so, things kind of intuitively make sense until they don't. And so they look at something, a lot of times they're bringing in they're ready to bring in investors or someone outside source in. And they may have questions that the owners, CEOs can't answer. And so then they bring in someone like me to help explain what's going on or to help make sense of things, especially when they've grown quickly and the accounting side of things hasn't kept up. They've kind of just let it go and builds. And all of a sudden they're at a situation where something's looking funky on their balance sheets or their income statements.
Right. So they're like, well, there's more and more money in the bank and what else do I need to know? I got, making money what you want, but then
getting ready
they don't realize,
open a new location potentially or a warehouse. And they're going, okay, yeah, it looks like I have money in the bank, but do we really have money to do this? There's obviously some cost when you're doing that kind of thing. And so just gut check, double checking things, making sure that everything is the way that they think it is, or they've gotten to a point of they could explain little things at one point. Now it's gotten to a point where they have either a few months of things swinging back and forth that they're not expecting without any good reason for it. A lot of times you'll see that happen with inventory. All of a sudden swings 1 month, or they have large adjustments month over month without really any good explanation for what's going on. And so then they are looking for somebody with expertise in that area to kind of help bridge that gap and explain what's going on. So
it's interesting, like reflecting on my own journey as an entrepreneur. I know that of the three main financial documents, like the P&L was the first and most intuitive one to understand. And then eventually I was like, okay, fine. I see the point of the balance sheet. And then even still, sometimes I'm like, the cash statement, how can I, I know that it's how I make sure I don't have a cash issue, but does that seem like a useful frame in leveling people's
absolutely, yeah, that's fairly typical. Your P&L, or income statement, whichever way you want to refer to it, it's the same thing. Really is what people are used to with your bank, kind of with your bank statements. Your money comes in, your money goes out. That's what it is. The balance sheet comes in, and that's something that's a balance sheet is not quite as important when it's a service-based business. I shouldn't say not important. That's not true, but not as extensive when it's a service-based business as it is when you're a manufacturer and you're carrying inventory and you're carrying potential, accounts receivable, accounts payable terms with clients and vendors and or customers and vendors, I should say. And just, that's a piece that's not quite easy to understand. The more you work with it, the more you're like, okay, I get this. The cash flow statement's the one that a lot of times is actually probably more beneficial for people because you can actually see, it's to show you where that cash is going, because your P&L is not going to show you the actual balance sheet, your actual balance in the bank, right? Where your cash flow statement shows that it kind of marries the two together, marries your two main statements with that, and shows how your bank account itself is actually differing and why why you have money in the bank or why you don't have money in the bank, where that's going.
That's so interesting. Just to circle back briefly, and because I was going to mention earlier too, on the P&L or the income statement, like you said as well, the other thing that took a long time for me to kind of get a hold of, and I'm curious to hear your perspective on, is okay, well, why does it matter what the gross margin is? What does it matter what the overhead is? It's all just income and expenses. At what point should people start to care about those kinds of nuances?
That's a great question. at first, when you're first kind of getting started in a business, you're just like, okay, money in, money out, right? And kind of be kind of, you should have a gut feeling as far as what it is. Are we selling, a lot of it is, are we selling the product at a high product, or if you're a service-based business, are we selling enough to cover our expenses, right? Is our price high enough? But once you kind of get up into that low 7-figure range, a lot of times, even sometimes before that, depending on what kind of products you sell, you're looking at more of, where is my money? Like, where am I spending that money in a way that makes sense? Are we spending money on the cost of goods itself to actually sell, the actual product going out the door? So that's your gross margin. Is that, do we have enough money there? Obviously, are we just covering our costs? And that's not just costs of the actual material itself. That's also including freight and duties and packaging and all of that kind of stuff that goes into that final product going out. And then, to get to your net profit at the bottom line, which is kind of the big number that everybody's looking at to see if you are actually making money, is covering all those other expenses that if you have a building and your rent or mortgage on that building, are we selling our product at a high enough value that we're also covering those items as well? The freight, if we're covering freight to customers instead of, them paying for freight, that's got to be included in there. The salaries of people that are like this, or other positions that are important to running a business, but aren't truly involved in the cost of the product itself. And that's, you're looking at that in that bottom section, what we call the SG&A, selling, general, and administrative expenses. They're making sure that, you're covering those costs as well on that to get it out the door to actually truly make a profit there. And so you're looking at that. And then you also want to start kind of looking at, can we split out the revenue, split out the costs based on different characteristics that we're selling to? So either different types of customers that we're selling to. So say we're selling to retails, and we're also selling off of our website, and we're also selling one-on-one to somebody in a pop-up shop, for instance.
Yeah.
Those are 3 different ways of selling your product. You want to start looking at, can I split my costs out that way to see, am I making the same amount of profit in my pop-up shop that I'm selling to my retail stores? Or is my retail store, dragging and I'm not making a profit at all for those that are being there? And so we maybe need to look at changing our pricing around or changing our mix as far as where we're selling our product, and helps you make better decisions as a business as to where you're going to be most profitable and where it makes sense to put your money and spend your money on things.
We have seen that too, where people have whatever their online store is where they started, and they are reluctant. They finally see their costs and they're like, oh my goodness, we're kind of getting killed doing online set. Now we've broken into retail or whoever else. At least they know they're getting killed. And they're like, listen, these were the people who got us up and running, right? Some people are like, gone. No, you can buy us through whatever retail store now. But other people are like, okay, yeah, I know, but these are the people who are with us the whole time.
And it's perfectly fine if you are wanting to sell at even a negative margin through your website. It's just another piece of information to help if you do want to keep expanding, right? Or keep growing there. Yeah. And, and it's good. A lot of times the business owners or CEOs don't even realize that much of their market ways are profitable. So that's one way you can split it. I've also seen, we've split at other companies that I've been with, we split things by actual product line itself, as opposed to market of where we're selling it. We split it by, we make a bunch of different products. We make, wire sensors, and we make air tire pressure sensors, and we make other, and they split it out that way too, which gives you another way to kind of look at your data and look at where your sales are. And again, make those decisions as to, do we want to stay with producing these lines, or does it make sense to kind of pull out and say, sorry, we're done with this. We're going to shift our focus now to another area.
And, I'm glad you brought that up. That's one of the places we often see too, they'll identify, okay, that item or that product line has a bad margin. Do we want to move away from it, or do we want to lean in and see why? Do we want to see, because the labor cost per unit is higher, and like if we had this piece of equipment, it would be worth it. Can we afford that piece of equipment?
Yep.
And like now here is the cost of keeping the item at the right, and now you get your trade-off, right?
Yeah, absolutely.
That kind of leads
all kinds of business
sorry.
decisions you can make based off of that information. It's just more information to make better decisions on.
So that kind of leads me into another question, like, because you mentioned the reason people will come to you or realize they need some outside, accounting support. And I guess there's two forms, right? There's like an outside reason, like a loan or interest in acquisition or something like that, or there's an internal need for better decisions, and they identify better accounting as a way to get to better decisions. What do you find like the balance is between the two? Because I feel like a lot of people probably move backwards into it because of an external motivation. They're like, oh yeah, now I can make better decisions. I should have done this all along. What kind of balance do you see there?
Yeah, I definitely see it's much more likely that they're in a situation where they have an outside person source looking for the information from them, and they can't kind of give the information that they're looking for or provide it for them in a way that makes sense to their outside source, because it doesn't always make sense to them internally. And so, a lot of the CEOs, a lot of the business owners, they've got so much on their plate too at that point that it doesn't make sense for them to try to dig into it. It's kind of one of those you don't know what you don't know situations. And so do you spend your time trying to learn it and figure it out, or do you bring somebody in that has had the experience, and somebody like me, where I work as a fractional controller, CFO, where I can work with multiple clients. You don't have to pay me what you would for an interim CFO, but I can still provide a lot of the same details that they do. I'm just not necessarily on site with them on a daily basis, but my clients have access to me at any point in time as well. So, I can answer their questions on things. It just, they know that I'm not necessarily, if they want to have a meeting this afternoon, I'm like, sorry, I'm not available. Not much different than it is for if I was on site and had meetings scheduled either. But it is a fraction of the cost for them they don't have to worry about benefits for hiring a fractional person. They don't have to worry about, the cost, just base salary for it. And a lot of those, they don't necessarily need that full-time person anyways. It's just the work level isn't necessarily there for a full-time person, but it's there they do need some additional assistance. And in some cases, it's also training people that they have on site, or I shouldn't even say on site, but already part of their staff, and helping them kind of figure out, because a lot of the clients that I've worked with, their bookkeepers or accounting staff don't have the experience. They're new to the company, new to manufacturing a lot of times, and just don't know how to make those changes or to pull the information that they need to, or even where to start to be able to get that information that they want to look at, or even what information is even possible for them to look at. And a lot of times it's just kind of a situation of, okay, this is something that I would like to see, but we have no idea how to get it. So let's bring in somebody that does and see if it's even something that's possible to get out of their system, or even beneficial to them, because that's part of the role we play as the fractional CFOs and fractional controllers, is what information do they really actually need to be able to grow for them.
Right. Absolutely. And then, so in that first case where they come to you, in the majority of the case, right, where they come to you because an outside reason, a loan or an acquisition or whatever, has prompted that somebody external needs some knowledge and controls. How frequent is it that in that circumstance you begin the investigation and to support them, and at the end of the day say, well, like, it's too late, like, to have that data point, right? Like, you need to actually hire me 2 years ago and implement a process to track this, and then you would be like, now we'll have to settle for an approximation or whatever, but it would have been better to have a different process all along.
As a very knowing smile, Shalena, from this question.
Well, I'll be honest with you, that's probably the cases in 95% of the time, where it's just, because a lot of times what happens is that they maybe weren't doing things, I hesitate to say the word correctly, but that's because that's not the right word, but they weren't doing things, they didn't have the processes in place. They didn't have the knowledge at the time, or even necessarily now when they bring me in, on what they are going to need in the future, right? It's kind of a situation of, if you bring somebody in up front, we can set things up right away to future proof you, if you will, versus kind of trying to play catch up in the background. And so a lot of times we can still get that information for prior years and still get that. It's just going to take a little bit longer. And the thing to remember too is that by the time you bring me on, we usually have had 2-3 years of cumulative issues that have been small and now it's a big issue. And so it's not going to be something we can just snap our fingers at and have fixed in a month. It is going to be kind of a long-term situation. And the best way kind of at that point is to make sure we have processes. I spend, a little bit, a month or two, really trying to get to know the client, their current processes, their system that they're using, and then kind of, okay, here's what changes we need to make going forward. And at the same time, we're going to fix the stuff that's already happened. So it's happening concurrently, but there's going to take a lot of time to get that stuff, the back stuff fixed. But, we also want to get the procedures and processes in place right now so that we can fix things going forward at the same time. And we don't continue to add to that as we figure out, And a lot of times it's small changes right now, even if we don't make full changes and we're going to continue to make some more changes to things down the line, the small changes we can make right now as we identify them, help make that cleanup work and the future work go a lot smoother.
It's so interesting. I mean, I feel like all this points to companies should on average seek some financial maturity sooner than, events that help with that. I mean, like it seems very, a little paradoxical too. Like if people are coming saying, okay, to get approved for the loan, I need this help, but like, doesn't it feel like, shouldn't they first ask, would it be a good idea to get a loan and how much should I get? Like, like those questions that like, if they don't have the maturity to have the documentation, like how do they actually know that it's a good idea for them in the first place?
Yeah, there's a little bit of that. There's a little bit of what they can see in the financials, it looks good. They don't necessarily identify any issues up front because they just don't know at that point, and so yeah, from a lot of perspective, even if they do want to get the loan, it's like, okay, well, we've been making a profit up to this point. We have extra cash in the bank. Like we should be able to put, have enough to make this loan. And if by doing this, we should be able to, grow our business another 30% or whatever it may be, and nothing wrong with that. And not every business necessarily needs the help. But yeah, it's kind of if you're thinking about expanding your business a year from now, now's the time to be hiring that fractional help, or even a full-time person, and the other part kind of that doesn't get considered either. And does your current employees, are they doing everything that they should be doing before bringing in a fractional person? So what I mean by that is a lot of times bookkeepers, and this is not a slight against bookkeepers at all, this is just kind of the nature of things. A lot of bookkeepers come in and their job is to categorize transactions, to reconcile the bank statements, the loan statements and that sort of thing. And then maybe they do the financial statements themselves, or it goes to somebody else and does the financial statements. And then no further looking at the balance sheet is being done. They may look at a month over month kind of, oh, does anything stand out? But they're not actually reconciling all the accounts on the balance sheet. All the accounts on the balance sheet need to be reconciled before you go to the bank or some outside lending source, because they're going to want to make sure that those balances are truly what they are, especially when it comes to accounts receivable, accounts payable, and inventory. Those are the big hitters, and any loans and cash balances are usually already reconciled.
What you know, right? In terms of what's in the bank.
Yeah. But those other accounts, a lot of times people they don't have anybody that's taking responsibility for those accounts. And those are the big ones that the lenders are going to be looking at to say, okay, are we, by giving you a loan, are we overextending you with your current liabilities on there? Do you have money that you're just waiting to collect from clients or your customers? Is that balance reasonable? And how much are you still owing to your vendors as well? Like kind of situation. So all of that kind of goes into place, but that's not something that a bookkeeper themselves necessarily takes on. And so, sometimes you want to invest in more of an accounting clerk type situation, or an accounts payable or accounts receivable person, maybe in addition to, or talk with your bookkeeper and, change your scope with them so that they're reviewing that stuff too before you go to the lenders and try to get loans and stuff. Because that's what I've seen a lot of right now, is that they go to the lenders and the rest of the balance sheet hasn't been tied out at that point, and they're like, oh, does this make sense? And they go, well, yeah, I think so. But then when you actually look at the detail on it, all of a sudden you've got something that hasn't been collected for 3 months. 3 months past due, and it got hidden by some other stuff in there. And then, that leads to questions of, do you have the right stuff in place and all of that kind of thing.
How did that happen?
Exactly.
Would be a question a bank might ask.
Yes, exactly.
Yeah.
So, it's not just necessarily bringing on somebody like me. It's also kind of prepping for that additional work, because my role is not to actually do the work necessarily in the system for them. My role is to help guide them, provide guidance, double checking things, but the actual work in the system, the actual reconciliations, all of that kind of stuff should be done by somebody at the company themselves to do that.
So you'll define processes and procedures, make recommendations for what those should be, perhaps train the operations or bookkeeper who's going to be executing them.
Yes, wholeheartedly.
Yeah.
Okay.
Yep.
Earlier, you had mentioned you come into a place and they're 2 years behind on some of the things they should have been doing. You say, okay, we're not going to fix everything right now. Let's start with some of these small changes. But what do those typical changes look like for people who might be, 2 years too late? And also for people listening who, are ready to grow and are ready to start making a couple new adjustments to how they operate.
Yeah. So some of those things that they really, is really, again, looking at your accounts receivable, accounts payable, making sure that those numbers are what they are true numbers, making sure you don't have any duplicate invoices out there, that you don't have credits that are owed to customers that, haven't been paid off to them. Get some, do the work.
Customer who's never going to pay. And you just never.
Exactly. Yeah. And you have some of those too, that like, maybe you're supplying to someone like Walmart. Okay. Walmart is a big corporation to a lot of, small businesses. You're not going to necessarily you're not going to get Walmart to change how they're handling things to what you're doing. Right. So if you have an account with them and they're sitting there and you've got all these amounts that they short paid, get them you got to figure out how to get those off the books or how to do them, kind of make those changes, kind of making sure you spend the time looking at those things, knowing your customers, knowing your vendors, what you should expect to see from that, what the likelihood is of that. But then also really defining the roles of your people in-house and who's in charge of which parts of the business, I know saying silos is a bad thing. Having, that's kind of the trendy thing right now, is that we don't want silos, but yet there's something to be said about making sure that people you don't have too many fingers in the pot either. So really making sure that your functions are well defined for your people and that the entire process is being followed. And that means from the point of when you open orders, the orders in there, that all the products are set up correctly, making sure that a lot of times what I've seen happen is that customers or clients haven't closed the orders on their manufacturing orders or their POs, which can trigger in some systems. It can trigger a whole host of things by closing the orders. And by not doing that, then you can be driving some of the variances on your P&L and some other hidden expenses in there that when you do try to fix it or try to go back and close things, all of a sudden you're sitting there with inventory issues are doubling up because you already adjusted for that with the cycle count at some point. But then the system was waiting for you to close the order to backflush things. That happens quite a bit. Or just even costs. And so all of a sudden it doesn't pull all the costs that are associated with it. And it says you have production variances in there or, other inventory adjustments in there that don't actually exist. It's just the fact that the order didn't get closed out. The system doesn't know that that order is done and to send off that final processing of the order essentially. And then because then when you do try to go back and fix things in the past, all of a sudden you're changing P&L numbers and you're changing balance sheet numbers for days in the past. So really kind of making sure you understand your system and what the requirements are of your system and what it does at all those steps. So that's kind of the big areas to kind of look at upfront on those.
Absolutely. And one topic close to my own heart is inventory. I'm curious, accurate inventory and costing for that inventory. Like, is that a pretty frequent one where people don't know what they actually have, either in terms of like how much there is or what it's worth?
Yes. That's very common.
Yeah.
Especially in, like, you guys talk a lot about the batch processing and working with batches. That's something that is a bit tricky as far as a lot of times if you're buying things in tubs, but you're not using them in tubs, obviously, you're using them in a squirt here and there off of the machine, right? You're loading the tub into the machine. Well, if it's a 5-pound tub or, 5-gallon pail of something, first of all, you're not going to get the whole 5 gallons out of that tub. There's going to be some left on the tub itself. But it's also can be very difficult to identify how much is actually being used every time it's being mixed or every time it's being distributed.
I used 3/17 of a tub this time.
Exactly. And so, trying to figure out a way to both account for that in costs and account for that in actual inventory itself, like quantity wise. Those are very common issues to have. And unfortunately, there's not really a good, like, every company kind of handles things a little bit differently for those type of situations.
That's one of those areas where QuickBooks and systems that are built really for accounting, right? For growing companies, accounting systems really are missing a lot in terms of what a batch process manufacturer would need. And unit of measures is one of those areas, right? Like,
yes,
for example, like that's often where we get brought in too, right? Where they want to purchase stuff by the tub, but stock it by the kilogram or pound. And so they'll have that conversion factor and we'll allow them to do that. And then now it's in their own books by the kilogram, which is the way it should be for them versus what their supplier determined and do all those conversions. So that one's close to me for sure.
That one and conversion factors and unit of measurements are something that is probably number one on the list of potential errors when you're talking inventory. As far as you have a large inventory adjustment this month, that's one of the first things that I would suggest going and looking at. And a lot of times too, like you were kind of talking about, there's different unit of measurements depending on whether we're talking from the bill of material side or we're talking the purchasing side. And so being aware of which side of the system, how are you ordering it? So what is it measuring on the PO? So, like I see frequently we buy it in rolls that are like 100 feet of roll, roll is 100 feet, but we store it in the system as feet. So we need to make sure there's a conversion factor in there for that. And the unit of measurements in there correctly. And then we actually use it in inches type thing. So there's another, a third or secondary kind of switch over there. And sometimes that gets missed when, they're doing that, or you've changed vendors and all of a sudden you're not getting them in 100-foot rolls anymore. You're now getting them in, 10-yard rolls, or something. And nobody thought about it when they switched over to the new vendor that, hey, we need to also switch over the unit measurement and the conversion factor in there. So if you do see big swings in inventory, that's the first place that I recommend looking, is double checking all of your unit measurements and all of your conversion factors, especially for any new vendors that you may have or new products that you're looking at, kind of identifying those first out of your list of things.
Okay. So our inventory is well off. First place to check, you're saying unit of measures. What else is common?
Yeah. So some of the other places to look at that are your cycle counts and making sure your cycle counts are being done on a regular basis. But also setups is another area that doesn't always get accounted for. So something like we run a sample batch every time we change our machine over to a new material we're making. A new product we're making, I should say. And we do a quick little test run and nobody accounts for the drop in inventory of what's being used on that when you make that switch over. So, I have a fabric manufacturer who they run a 1 yard test run with a new design when they're putting it on the machine and getting ready to print that. They need to make sure we just ran into an issue where they had a large inventory quantity discrepancy on their base material. And they were like, I don't know what happened. And you're like, well, how often are you using that base material, that specific base material? And how often are you changing jobs with that base material? Every time that you change jobs and you run that 1 yard sample or 1 foot sample or whatever size sample it is, are you guys adjusting your inventory or even have it built into your bill of materials? Either way, because what you can do in most systems is set up like your very first operation for a part as a setup. And that would include labor. It would include the material that you're using on that. And that essentially would go kind of to a scrap account or an part of cost of goods, but just to identify that that's getting used there, even if it's not actual sellable material that's going to end up in your finished goods that's going out to. So that's another area. The setups and the setup fee, or I shouldn't not fee, but the setup itself and what
is kind of a fee. I mean, in your example, the client pays a yard of fabric every time they want it just to make sure their quality is right.
Yep.
It's interesting.
Yep.
I mean,
absolutely.
There's a couple that I've run across a few times. I'm curious to know for like when you get brought on, how frequent it is. One is the bills of materials aren't accurate and they're not recording actuals in production, right? They have a theoretical bill of materials. They don't actually keep track of what they use. They just assume the BOM is right and it's not right. And then that leads to a big variance that gets corrected at count.
Absolutely. Yep. That's definitely a big common area. Or even just simple, they've made a change to the process at some point and never went back and actually updated the system for that change that they made. That happens quite frequently as well.
Another one I've seen quite a bit is waste, right? And this would depend on the vertical, but like in food where the shelf life is short, it's, well, are you bothering to actually write off the stuff that expires and that you throw away? Or is this just phantom stuff sitting there, right? So that kind of hygiene around. Yeah.
Yeah, definitely. And along that line too, transfers. That was the one I was thinking of earlier, is that they keep things on they keep the bulk of their material in one place. They bring it out and store it at the production line, but somebody never does the actual transfer in the system. And then they go to do cycle counts, and all of a sudden that location in the warehouse is showing that it's supposed to be, 50 pounds of something, and they only have 25 pounds. And they're like, what happened to it? And they go and make the inventory adjustment, and then come back the next day, and they've done, like, they do a cycle count now at the machine itself, and now all of a sudden they have an extra 25 at the machine, and now you've done an inventory adjustment. And if your timing is off on that, say you do your cycle counts or you do your inventory counts as of December 31st, and then you do another one on January 1st, all of a sudden your adjustments are off on there, and you've got a swing in inventory adjustments right there, which again, to an outside source, while it's explainable, looks like you don't have your stuff together to be able to handle growing again in the future. So, just kind of small things, making sure your timing's being done and taking that into account. And I have a client that calls me the date Nazi, because I've learned my lesson a long time ago. Yeah. These dates matter. And when you are entering this, when you are entering, even if you're entering a fix into the system, make sure you're entering it with the right date, which it's okay to backdate things. There's nothing wrong with backdating things. I'm fixing something from October, for instance. I need to make sure that date is October, though, so that adjustment happens in October to counteract the initial issue, rather than all of a sudden having this adjustment in December when it doesn't actually belong there.
I feel that inventory piece is so foundational, like, especially like if I want to turn to cost of goods sold and I want to say, I want to know my cost of goods sold for each finished good product, your chance of doing that when your inventory is not under control, right? If you can't say, I know what my raw material and my finished good inventory is, and when I do a cycle count, or a count, there's very little variance, there's very little manual adjustment. Well, get your house in order first, because if that's not the case, then you've got no foundation to say that I can actually calculate my cost of goods sold, because there's something wrong in there. You don't know what it is yet, right?
Exactly. And so it causes your cost of goods to either be overstated or understated. In best case scenario, you have an equal number of understated and overstated situations where it balances out to looking appropriate. But, 9 times out of 10, that's not what's going to happen. You're going to have a swing one way or the other. And so then also too, you're looking at what your sales are doing, and all of a sudden your cost of goods, your gross profit margin month over month is all of a sudden swinging wildly, because you're not accounting for that in the right time or the right way. And
if only people could get the dates correct, just enter the dates incorrectly, we don't have to suffer.
Yeah, there's something to be said for that sometimes. Especially December 31st or the end of the fiscal year, whether that's the end of the calendar year or a different time, always gets hit with a large amount of adjustments. And that's not ideal either. That makes your numbers for the year to date to be correct, but that doesn't necessarily help you when you're looking at seasonability for some things. Like people in the food industry, you're going to, especially if you're doing kind of luxury food items,
Yeah.
Christmas time is going to be a big time of year, and if you're doing all of a sudden and you're following a calendar year and you're all of a sudden doing these large adjustments at the end of the year, it's going to take away from showing that, how much profit you have in there. It makes it a lot harder to forecast both from a scheduling standpoint, and production standpoint and a financial standpoint of knowing where you're going to be.
Can you share with us a little bit about how growing companies, right? We're a small company, we've got stuff under control, and we're starting to grow out, and we need to mature some of our processes around this. What are some things people should be thinking? There's people listening right now who's a growing company. What are the things they should be thinking about improving and focusing on that maybe they didn't need to when they were smaller?
Yeah, one of the things I really kind of push with a lot of my clients is really paying attention to the scrap number and how much they're doing in scrap. A lot of times
Really?
they let it, yeah, a lot of times they let that kind of flow through the inventory adjustment side of things as just a lump sum for inventory adjustments. But that's actually one area that for me, I've found has been really useful to try to identify the true scrap amount, what you're actually throwing out, and identifying necessarily the reasons behind that so that you can make changes to your processes or your procedures to account for that. Like we were talking about the expiration date, for instance, things that expire. We want to be able to identify how much of our inventory adjustments are due to expiration of product. Do we need to make a change to our purchasing side of things because we're purchasing way too much too early? Or potentially, yeah, it's going to happen if sales didn't hit where you wanted it to be. And so you can expect a little bit more potentially, some more volatility around the expiration dates, needing to toss stuff for that. But there also could be stuff that you had an employee that spilled something, and you had it happen one month, and then, the next month, something else kind of happened. And then it happens again the third month, and now you've got 3 months in a row where your inventory adjustments are large. It's costing you a lot of money because you're having to replace this. And so maybe it's time to have a real conversation with your employee at that point, saying, right, look, this is what what the impact is.
Peter, no more forklift. You are off forklift. You
exactly. Can maybe we need to shift you in a different position type of thing. Just being able to, identify why that scrap is happening, and kind of, because again, back to the discussion earlier about making better decisions, more data, better decisions going down the line. So that's kind of, the scrap is one that I recommend kind of trying to dig into, and not even just even dig into, but actually separate that out from a standard inventory adjustment lumps.
Absolutely.
On things.
That's interesting you mentioned it. That's one I've come across a bunch of times too in implementations where people need to correctly categorize that waste or that scrap. Like, did it happen during or because of the production process? Or was it something that happened in the warehouse, right? Like,
exactly.
It still happened during production, and as a result of the machinery, that's like contributes to COGS for that product. Whereas if the person was putting it away, like, moving it around and they spilled it, that's just like an expense to, you know what I mean? So I think oftentimes people need some literacy in the importance of, like, they might think, well, what does it matter? I'm going to get the inventory accurate either way. Well, it does matter.
It does matter because, right. Another part that kind of looks at that too is maintenance on your machines. Is our scrap rate growing in our production processes due to the fact that a machine is malfunctioning more frequently, or just in general, happening? It might be a slow, the machine maybe is 20, 30 years old and they're using it and it's slowly on the decline. And so it's, causing, not today, but maybe, today's orders are 2% scrap, but then, by the end of the year, you're looking at that's 4 or 5% scrap. Okay. We need to put some money aside for either maintaining this machine on a regular basis, or look at, what do we need to do to replace this machine down the line? Because, it's one step away necessarily from all of a sudden being 10%. And now, you're sitting there going, okay, that's starting to cost a lot more money to fix that. We're having to, run through a lot more of our raw materials, a lot more of our, time spent on the machine. All
It,
those kind of
it feels impossible to
hidden
capture
costs.
if you don't have a system, right? It just feels impossible. How do I know that it was this machine, or it was Peter in the warehouse, or theft was one that we've seen? You have just inventory adjustments missing because of all these reasons. It seems difficult to do, impossible, like a pencil and paper kind of approach.
Yeah, and there's honestly nothing wrong with pencil and paper in some cases. I will take that if that means that we're able to kind of track some of that, and just it's more of an informational, right? The more information you have, the better situated you are to react to things. You're not going to have this sudden surprise all of a sudden one month where you're like, oh my gosh, how did this happen?
We had no idea.
If we would have been looking at some of this leading up to that, and sometimes it's literally as simple as documenting it. It doesn't necessarily need to be put into a system anywhere. It can be as simple as a clipboard on the side of the machine, documenting different downtimes of things, having to document the inventory adjustment side of things and making sure that your team's disciplined enough to be reporting that on a regular basis, and also feeling empowered and not being scared to report that something happened.
Sure. Along those lines, actually, this is a kind of a funny story that I've run across multiple times now, which is that when companies start to get really serious about getting accurate inventory and posting adjustments and corrections and all of this, there's the initial instinct from management to kill the messenger all the time, where it's like, it's always, Shalena, that is, like, Shalena, you explain why you wrote off 100 pounds here. Like, I was walking around and I saw it was wrong and I thought I was doing a good job fixing it. Like, I didn't, I don't know.
I wrote it down. You told me to write it down, and now I wrote it down. Yeah. That's what the packaging machine does.
Right.
Yeah. Like, whoever actually spilled it was, they're long gone. You blame the, so
you'll never figure it out necessarily.
Yeah.
But
in the warehouse.
Yeah. So we often have to be like, no. Like, the person who's reporting, this adjustment, they're your best friend. Like, you need to encourage that, not make it hard on them, or else they're going to stop. Right.
Yeah. Right. A good thing there. Well done.
Right. And it's not, I think there's a tendency to think that it's a bad thing that you're reporting that there's an issue. Right. Mm-hmm. And really, it's really not a bad thing, because it's just, again, it's more information that you need. Yeah, there's definitely that tendency to kill the messenger at first. So really, kind of from a CEO or CFO standpoint, kind of making sure you're not kind of victim blaming, right? And just kind of, thanks for bringing this up. But also, when you've noticed a pattern and something happening, bringing the team together and saying, all right, what's going on? What we found kind of too over the years is that giving ownership to your employees really helps with them, bringing up issues or bringing up ways to save money on machines, or things that they're finding, because they're the ones that are working on them, working and actually making it happen. So they're going to see things that upper management is not going to see. Even the operations manager is not necessarily going to notice it, because they're juggling multiple things going on too. So really try and trust your employee, and when they bring something to your attention, trust that they're telling you, because they don't want to lose their job either. They're not telling you to to try to bring up trouble or stir up trouble. They're trying to identify things that, hey, this may be an issue down the line and cause issues. So
it is kind of nice too, when you finally have, like, okay, here's the spills and here's what we're losing on the packaging machine, and here's some of these aren't, like, we always thought it was bad. These are actually fine.
Yeah.
It's Peter on the forklift we have to worry about. And now that's sort of like, hey, now we can focus on that's my next problem, is the packaging machine. And here's the scrap and making their way through it, informed, right? With cost.
Absolutely. Yeah. And we talked a little bit about this, where we talked about having the bombs correct and making sure, if you're putting scrap into the bombs, like you're, already increasing your materials by, 10% to account for some scrap that you're going to have. You may get in there, and by tracking the scrap and tracking that separately, you find out at the end that, our scrap is only 5%. We don't actually need 10% anymore, kind of thing. It's a great great problem. It's not everything is a bad problem, right? Like,
Yeah.
it's not, we have a tendency to think that way, but there is also good areas of, good results from tracking that kind of thing.
Most problems are opportunities, right? So
Absolutely. Yeah.
Yeah.
Positive thinking. Finance tends to be a little bit more negative and pessimistic in our view, but there are usually positives that come out of it as well.
I feel like a lot of the work you do beyond the first layer kind of reveals a need for some kind of transformational change of one kind or another. And it can be like probably a lot to swallow. I guess there's so many different ways to ask this question and answer it, but like, do you get a lot of resistance from ownership, management, staff? Like where, does the resistance come equally from all those areas? Is there a particular like common thing that you find that nobody wants to they always just like, no, this is how it is. We don't want to change it. What do you find there when you make recommendations around resistance?
I find with the smaller companies, the smaller businesses, there's not nearly as much resistance because they're aware. A lot of times they're aware kind of whether they realize it or not. They've in the back of their mind, they are aware that what they're doing is not necessarily best practices or it's the way we've been doing this, but we've been doing it this way for 3 years, 5 years, 10 years. Is this really the best way to be doing this going forward? A lot of times I find in my job, as long as I can explain why we're making the changes and how that's going to impact them and impact the financials of the business, and also that we're not trying to add more work to them, that by making these changes is trying to head off some of the time that they are spending right now on other fixes for it. If we make this change now, we won't have to deal with that going forward once we get the back stuff cleaned up, of course. And so, no, I don't see a lot of resistance for those smaller, medium-sized companies. Because a lot of times, and really even at the large companies, if you can explain to them why you're making the change and how it's beneficial, they're much more
open to it.
Open to making those changes and not so reluctant to it. Change is hard. Nobody likes change. We all know that.
You lead with the purpose, right? You lead with why.
You lead with the why. And, a lot of times they are actually really happy to see somebody like me come in because I can help provide another viewpoint of things from what they were looking at. And in some cases, I can verify what they've been trying to tell for management, the CEO or production manager or whatever for a while, and they're either not understanding it or whatever. Or like I have right now, one of my strengths in particular is being able to speak both accounting speak and operations speak, and being able to explain the concepts from an accountant. Like the accountant will say something and the owner will look at them and go, "What are you talking about? Like, this doesn't make any sense. I want to know this." And the accountant's answering them in a way that they think they want to know, but the owner's going, "That's not telling me." And so then I come in and kind of translate between the two and go, "No, what she's looking for is this. And this is what we're trying to get to." And then they go, "Oh, yeah, we've got this. And here's this and this and this kind of situation." So, and then we see it a lot on the operations side and between operations and accounting where they just aren't speaking the same language. And so accounting says you need to do it this way. And operations is going, "Why do we need to do it that way? It doesn't make any sense to us." And so, what a lot of mine is translating between the two to make them on the same page. But I also come in with a little bit different philosophy than a lot of accountants, which is operations runs the business and then accounting needs to support operations, not accounting's running and operations supports accounting. Because without operations, you don't have a business and you don't have accounting to worry about. So operations, needs to do things the way that makes sense to them. And we need to just cover it on the accounting side and figure out how to get what we need from that piece of things. So it's just kind of bridging that gap there for them. And so once you can do that, people are much more welcome and open to taking any suggestions you have for them.
The connection from operations driving the business over to accounting is something we run into a lot. Do you find senior management is receptive to that kind of viewpoint?
Yes, it actually helps them a lot. Because like I said, for most people, accounting is not instinctive. They don't know the accounting side of things. And so they hire somebody who does know the accounting side of things.
Sure.
But the accountant side of things, a lot of times they are worried about, there's certain regulations and process, gap, what's gap or IFRS if you're international. There's different guidelines for them, but even within those guidelines, you don't need to change operations to meet those guidelines. It's just, those are reporting guidelines and how we need to report things. That's not how to actually run a business. And so the operations side is running the business and making sure you get product out the door. From an accounting side, we just need to make sure we're recording all of that information and, recording it in a specific format. But, it makes the upper management's life a little bit easier to come in and say, operations side, I actually don't want to make any changes to the operations side. It's not my job to make any changes to the operations side. I can maybe help if we're talking productivity or, some of those kind of things. We may need to change a little bit of, you want more detail on things or more data on things. We may need to change a little bit of how you're entering the information or how you've created a bomb in the system, something like that, or how you maybe have work centers set up or, personnel set up in the system. But for me, that's not changing operations much. You run the business how you need to run the business, and I will grab the information I have from that to make our accounting work. And that's really the way that all of us should look at things. But it's also kind of something that's a little bit more unique to the manufacturing side of things than it is, or manufacturing and even inventory. Because, you can have inventory without being a manufacturer, but kind of more unique to that side of things than it is if you're just a service-based business. A lot of times there's not a lot of people that like to work with the inventory and the manufacturing side of things. So they come in with their experience elsewhere and really they don't know how it should work. And so they get stuck kind of trying to figure out how should we make this work? Well, we need you to do this. No, operations runs the business. We, on accounting side, it's our job to support operations, not the other way around.
One question I love to ask, people deploy an ERP and all of a sudden they go from having probably financial data, right? They get the data, whatever data they get out of their QuickBooks or whatever their financial system is, to suddenly having a lot more data. And in fact, like an overwhelming amount, right? And they often want to know, okay, what can I do with it, right? Like, and often need some guidance to focus in and say like, okay, here's the one KPI that you look at next. Now that you've gone beyond the financial documents, here's what you can focus on, or maybe the 3 things that you can focus on, and then you get processes built around them and tune them up, and then perhaps you move on. Do you have like a favorite or a top 3 greatest hits KPIs or things to look at, like off the financial statements, that you would point to for manufacturers?
So for me, kind of some of the big heavy hitters, if you will, are going to be so from an operations standpoint, efficiencies. So we're looking at your machine and labor efficiencies. Are those running effectively? I've talked a lot about scrap. That's scrap and inventory adjustments. For me, that's huge. Like I have a client right now that we're looking at that they are currently cumulative almost $200,000 in inventory adjustments from last year. And their inventory is, like $3 million almost $3 million in inventory a year. And I looked at that and went, that's not okay. We cannot have $200,000. And the bookkeeper I was talking with them, she was like, well, but that 200,000 cumulative is good compared to the month over month swings. And I was like, that's even worse. Like that's not good at all. That's way too high for inventory adjustments. There's no way. We're missing something somewhere. So looking at the efficiencies, but also the inventory adjustment piece of things, how big is that, especially compared to your standing inventory numbers on your balance sheet? More of kind of some of the financial side of things, a days past due for your vendors and for your customers. So looking at your AR days past due, those are kind of the big ones that I find are most beneficial. I mean, everybody's aware, obviously, of your gross profit and your net profit percentages. Those are huge, of course, as well. But, the ones that I kind of dig into more are, like I said, the inventory and scrap adjustment rates, the efficiencies. Once you have that data, the efficiencies are really helpful for determining kind of where you should be spending time. And also, looking at if you have a work center, or I shouldn't even say work center, say you have multiple employees that are at a work center, and you see that one month they are running at 40% efficiency and the next month you're at 80% efficiency, and it's two different people. The question is, what changed over month? And, is there something that one person's doing better than the other person that they can make changes to the way they're doing it? Or is it something that maybe that person isn't necessarily best suited for that? Or was it an external factor that month that they just had a lot of downtime because they did have a maintenance issue on it, or there was a lot of meetings or something along those lines that they weren't actually running production? Those kind of things, when you do get kind of the data available, those are some ways to use that data in a way that can help you drive better business practices and better business decisions on that.
It's fantastic.
I'm out of questions. My brain is full.
Yeah. I guess one last one I would ask just to finish it off would be, once you've kind of worked with a company to solve their initial problem, and then maybe they graduate to helping them to drive some more improvements beyond into these, the KPIs and so on, how do they sort of graduate from needing this outside consultant yourself to like kind of connect the dots for them and say like, okay, next you need this KPI and here's what to do with it? And how do they graduate from building that muscle internally in management or in ownership?
It's always a never ending kind of change. It's kind of, once you're tracking a KPI and you kind of feel like you've gotten a handle on it, both from a understanding what's driving that KPI, but also that KPI is either consistent or consistently growing or consistently decreasing, depending on what kind of measurement you're tracking. Then it's okay, what's kind of our next thing we want to do? What are we looking at next? What's our next goal for this? One that we used to track that I don't see tracked very often right now is looking at getting our time from order production to out the door to the customer, and kind of, can we improve that from a customer standpoint? Because then you start getting into value-based pricing instead of just straight up cost pricing, and being able to say we are able to charge higher prices to our customers, even though our costs of goods are not necessarily that high, because of the value that they know that when they buy from us, we can out the door to them in a week, as opposed to other people that, is going to take them a month to do it, or 2 weeks even,
Right. When you kind of plan ahead, call us because we can get it done quick. And of course.
Exactly. Yeah. And so then all of a sudden now you can start charging a little bit more premium wise, because that's something that is valuable to your customers. And instead of just looking at, we want to charge a 20% margin over our cost of goods and pricing that way, gives you a little bit more price frequency, gives you a little bit more ability for that to higher profit margins in there as well. So just kind of, okay, what are our long-term goals on this? What do we want to do? And what kind of things do we need to track? Because if it's not being tracked, it's not going to be achieved. And so you need to kind of put the things in place for tracking before you get to that goal, or making that a goal. Is, okay, what kind of things, what do we need to do to be able to achieve that goal? If it is we want to improve our gross margin by 10% over the next 2 years. Okay, what kind of things do we need to do now to start putting in place to start growing that? And like I said, things like looking at your time to delivery from order placement to actual delivery to the clients. Looking at if there's returns, what kind of return margin, return margin are you looking at from your customers? Are they returning 10%? What do we need to do to improve that to get it down to 5%? Lots of, kind of, so then you got a root cause analysis of why you're getting all those, why you're getting your returns and all of that kind of stuff, what kind of things can change. But when eventually, hopefully, with working with me, we get to a point where you're wanting more KPIs and you're wanting more time than I can give to you as a fractional. And we say, you know what, now it's time to bring in a full-time person.
Right, to a full-time person.
Yep, exactly. So, that's always the goal when you're working with me, is we get to a point where you don't need, I've worked myself out of a job essentially, where, you need to have somebody full time, and it makes sense at that point to do that sort of thing. Or even somebody that is still maybe part-time, but they're working 20 hours a week for you instead of me working, 5 to 10 hours a week or something like that. And generally speaking, you're going to be paying, by the time we get to that point with me, if I'm putting in that many hours, you're going to be paying me probably close to having a full-time CEO or CFO at that point anyways, or controller position. So just kind of work myself on it.
If people want to find you, how best can they find you, Shalena?
Yeah, so I have a website. It's bluegoldACCTservices.com, and they can go out there and find all my my current packages services that I provide, and there's contact me on information on there as well. Or they can look me up at LinkedIn, Shalena-Hardy, and yeah, I think I have a Facebook page too, and Google. But yeah,
that's good. The first two are enough, probably. Yeah.
Yeah,
it was so great. So great to have you. How lucky are we? Thank you so much for joining us.
Absolutely. Thank you guys for having me. It's been a pleasure.
Thanks for the conversation, Shalena.
Thanks for watching the Better Batch podcast. We're so happy you could join us. If you've got an idea for show ideas or you just want to improve your manufacturing, reach out to us and we'd love to hear from you.